The Federal Reserve System, commonly referred to as the Fed, is the central bank of the U.S. This financial institution is arguably the most powerful one in the world. As the central bank of the U.S., the Fed has exclusive authority over the creation and distribution of money. It can print money out of thin air, and they have done a lot of that the last couple of years. More importantly, they are independent, outside of government control. Pause and let that settle in for a minute. There is one organization headed by one man that decides how much money will be in circulation. Why would we put our country's money supply in the hands of one man? For us to understand why, we need to understand what motivated the establishment of the Fed. What is the Federal Reserve System and why was it created? The Fed has exclusive authority over the creation and distribution of money and credit for the country. The board of the Fed is made up of 7 members. Additionally, there are 12 Federal Reserve banks, each of which is led by a different president. The 12 presidents represent different districts. Each of these banks is in charge of a certain geographic area in the United States. These are Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. The Board of Governors consists of 7 members. The President proposes these individuals, and the U.S. Senate approves them. Each governor can hold office for a maximum of 14 years. Their appointments are spaced out by 2 years to reduce the President's influence. Additionally, the law mandates that selections must reflect each of the major U.S. economic sectors. Now, why and how the Fed was created? The Federal Reserve Act created the Fed, and it was signed by President Woodrow Wilson on December 23, 1913. This act came as a result of the financial panic of 1907. This financial panic caused devastating economic disruptions that came from bank failures and company bankruptcies. Americans needed an institution to pull their country back up from the slump. All banks in the U.S. were put under the Fed. The Fed was given the authority to take action to ensure financial stability. Member institutions can turn to the Fed when they have nowhere else to turn for financing. The Federal Reserve serves as the lender of last resort to its members. When the economy needs money, the Fed can, as it did, print money from thin air. It is then the banks that distribute that money to Americans. If any one of you received government assistance during the pandemic, notice that the government didn't give it to you directly. They gave the money to the bank and the bank handed it to you. Have you ever wondered why? Why can't the government keep our money and deal with us directly? Why do we need banks? We will be discussing that in an additional video. First, let's understand how the Fed creates and makes money. The Federal Open Market Committee, FOMC, and associated economic advisors meet regularly to look into the health of our economy. If it's determined that new money needs to be created, then they assess how much needs to be injected into the economy. The next question is how the Fed increases the money supply. The Fed starts an open market operation. The Fed buys and sells treasuries from a bank. They pay the bank using the money they created by depositing it in the bank's reserves. In the early days, money creation meant printing paper notes, and new metallic coins would be created and released to the public. Central banks have become much more technologically creative since then. Money doesn't have to be physically present to work in an exchange of money for goods and services. Today's Federal Reserve buys new, readily liquefiable accounts, such as U.S. Treasuries, on the open market from financial institutions to add funds to their existing bank reserves. Although we still print money, that job is handled by the Treasury Department's Bureau of Engraving and Printing. The U.S. Mint makes the country's coins. One thing is true, though: the Fed directly affects the economy and the quality of our lives. First, the money supply affects the value of the dollar. One of the most evident ways the Fed directly affects our lives is during the last pandemic, when the Fed printed money to give Americans financial assistance. they tanked the value of the dollar. Your money lost its power. Next is the interest rates. The Fed lowered interest rates to encourage business expansion and increase consumer spending. It helped kickstart a sluggish economy. And if an economy is growing too fast and inflation goes up, the Fed can increase rates so growth can be slowed and stabilized. Third is the Federal Open Market Committee, the sale and purchase of U.S. government securities on the open market to influence short-term interest rates and growth of money and credit. Fourth, the Fed also has the authority to change the reserve requirement. A bank's reserve requirement is the heart of our fractional reserve banking system, which means that a bank only has to keep a small fraction of its customers' deposits on hand. The rest of the money is made available to lend to other people for home, auto, business, or personal loans. The process creates money and puts it into play in the economy. Adjusting this reserve affects the amount of money a bank can use. When the Fed changes the reserve requirement, banks will be able to lend more or less money. Right now, the Fed is busy trying to get the inflation rate under control, and things are not looking good. Although they declared they will only increase interest rates half a basis point, inflation remains elevated. Do you think that we are in a situation because the Fed is failing at its job, or do you think it's the failure of the whole system and that what we need to change is the whole system? Let me know your thoughts in the comments below. This has been Ivory Hecker for Noble Gold News.